Welcome back, guys, and let's get started. Now, a few key concepts in the smart money trading plan require practicing on the chart before grasping the trading strategy I'm about to share. First, we have market structure and direction. This involves determining the key levels of the chart's structure and identifying bullish, bearish, and directionless markets. Next, we have optimal trading zones and order blocks. These areas on the chart can potentially provide us with high probability trade opportunities. Moving on, we have liquidity concepts. Liquidity fuels all markets, and it's crucial to identify where positions could be liquidated to prevent unexpected losses. Lastly, we have entry setup and managing an open trade. Once certain favorable conditions line up and we find an entry point, we execute the trade with specific order details. Also, managing open trade requires monitoring market conditions and adjusting for potential success. If you're new to trading and uncertain about these concepts, we recommend watching our previous videos on these topics first. Now let's get into the strategy. This trading plan consists of two major time frames. First, we have a higher time frame in which we will do most of our general analysis. We will read the market structure to find the direction, key levels, fair value gaps, liquidity areas, and more importantly, optimal trading zones that might potentially provide us with a high-quality trading setup. In the second part, we will zoom into our lower time frame to find confirmation and enter the positions. Remember that this trading plan is not limited to any chart or time frames. However, your entry time frame must be 2 time frames lower than your general higher time frame. In this video, we are only going to use 2 time frame combinations. If we analyze the market structure and find optimal trading zones in 4 hours, we will look for confirmations and entries in 15 minutes. Similarly, if our higher time frame is the 1-hour chart, we will zoom into 5 minutes to open positions. Now I have simplified this trading plan into 5 simple steps. After we go through the steps, we will look at the entry models to explain how the strategy could be implemented visually. If you cannot completely understand each of these steps, be patient because we're going to explore them in depth with multiple real chart examples. At the end of the video, I will show you the backtesting results, which will provide real evidence of how well the strategy has performed in the past. So let's start with the first step, analyzing the market structure. In this general analysis, we implement the market structure concepts of smart money to the chart to simply find the market direction and key levels. We have 3 types of markets in terms of direction. We have a moving uptrend, where the price continuously makes higher highs and higher lows, breaking the structure to the upside. So we want to trade with the dominant uptrend because it increases the chance of success. This process continues until we get a change of character, which signals a possible reversal. Change of character occurs when we get a break and close below the lowest point of swing low between 2 consecutive highs. Second, we have a moving downtrend where the price continuously makes lower lows and lower highs, breaking the structure to the downside. Once again, we want to trade with the dominant downtrend until we get a change of character. Then the market sentiment will change to bullish. We also have a directionless market, which occurs when the supply and demand are not powerful enough to push prices into a directional trend. When we continuously get changes of characters on the opposite side and can't surely identify the trend, we have a directionless market. This trading plan is a trend continuation strategy, so implement it when you can clearly identify the price direction. Here we have pound yen on the 4 hours chart. Let's implement the first step to find the direction and key levels. Here we have a clear moving uptrend that made a series of higher highs and higher lows and breaks to the upside. The market sentiment is bullish, and we only want to look for buying opportunities. These are 2 of the recent consecutive highs, so the lowest point of this correction is our swing low. And as long as we stay above this key level, we identify this market as bullish. The second key level is our latest high created by the price, which we will use to set our higher time frame target level. Now let's continue and see what the market will do next. Here we can see that the market broke structure and created a new high, but the market barely pushed the price upwards, and look at all our rejections, which shows a significant momentum loss. Then we have a break and close below the latest swing low, which makes it a valid change of character. Now we are no longer in an uptrend, and all we need to do is wait for a 1, 2, and 3 moves to the downside to identify the direction as bearish. Then, we mark the most recent key levels and look for short opportunities. Now this is all we need in the first step, identifying the market direction and key levels. Let's continue with the second step, key concepts of smart money. This step will identify fair value gaps, liquidity areas, and optimal trading zones on the higher time frame chart.
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
Three candlestick pattern characterized by a significant gap between the shadows of the first and last candles, with no overlap. These gaps are created when we have an imbalance between the buyers and sellers, resulting in sharp moves. The market often returns to these gaps to take the remaining orders and restore the balance. Then, if we have enough liquidity, market will seek to continue in the same dominant direction. Liquidity is the fuel of the market. Liquidity areas are where retail traders enter the market and place their stops. Let's focus on equal highs and lows and the latest swings for simplicity. If the market grabs the liquidity areas, the chances of success will significantly improve. Optimal trading zones refer to areas where high-quality trading concepts conflict. Valid order block and order flow areas that meet the rules will be great levels to look for trading opportunities. Now, let's apply the second step to the real chart examples. Here on the Euro-Dollar 4 hours chart, we have a moving downtrend. These are the considerable fair value gaps that are recently created. If the price returns to fill the gaps before continuing its general direction, it will provide us with a perfect trading opportunity. Now, where's the liquidity area? We know for a fact that this level was our previous swing low. So if the price returns to this level, support turns resistance, and we expect a form of rejection. Traditional price action traders will see this as a short opportunity and sell the market. They will place their stop above the zone, which makes a lot of liquidity gather above this zone. So there is an opportunity for the big players to grab the liquidity they want, and the price will fall after the stops are triggered. This is why you have to identify the liquidity, or become the liquidity. Now, where is our optimal trading area? The candle that created the bearish inefficiency or the latest bullish pressure before the drastic move to the downside is a great place to look for short trading opportunities. But no matter how good your entry zone is, the market can easily ignore it and continue with the dominant momentum. That's why we need double confirmation and witness reversal signals on the lower time frames. Here on the dollar-yen 1 hour's time frame, we have a moving downtrend. Let's apply the second step and mark the fair value gaps, liquidity areas, and optimal trading zones. We have a considerable fair value gap here, so we point it out. The market has created strong resistance and rejected this level multiple times, so we have a lot of liquidity gathered above these equal highs. This order block is a great area to look for short opportunities since it has a lot of great confluence. These are all the concepts we apply to the chart in the second step. In the next step, we wait for the price to come and mitigate the fair value gaps. Then we will zoom into the lower time frames to look for confirmations and enter short positions. Now let's continue with the third step, the confirmations and entry. In this step, we will apply the market structure concepts, wait for entry signals, and open the position aligned with the higher time frame analysis. After mitigating the fair value gaps area, we will look for reversal signals to confirm the entry. We must wait for a change of character to verify that the short-term trend is over and the market can continue going with the dominant higher time frame direction. If we have no change of character, we will have no trade. After the change of character confirmation, we have two entry trading models. In the bullish scenario, if the change of character move creates a valid order block with fair value gaps, we will place a buy limit a spread size above the order block and stop below the swing low. We will make our trade break even by closing half our position when the price reaches our 1 to 2 target. Next, we will close our profits if the price reaches our higher time frame supply area. The second trading setup occurs with no fair value gap and order block. In this case, we will put the Fibonacci retracement tool from the start to the end of the change of character move and place our buy limit precisely at the middle of the 618 and 786 levels. Our stop will be below the swing low and apply the same concepts for taking profits. Now let's have a quick recap of all of the steps we discussed. In this trading plan, we use two time frames. We have a higher time frame in which we do most of our general analysis and assess market conditions. Then we will zoom into the lower time frame to find confirmation and enter the trade. This trading plan is not limited to any time frame, but your entry time frame must be at least 2 times lower. In the first step, we analyze the market structure to find the market direction and key levels. We will point out breaks of structures and character changes to identify the market direction and mark the key levels that price can react to. For example, here we have a moving uptrend with multiple consecutive breaks to the upside. Since the direction is bullish and we want to trade with the dominant trend, we are only interested in long opportunities. This is the latest high created by the price, which we expect a possible reaction, making it a suitable place to set our long-term target. This level is our recent higher low, which is also a key level, and if we get a break and close to the downside, we will no longer consider this market an uptrend. In the second step, we apply the key concepts of smart money on the chart and identify fair value gaps, liquidity areas, and optimal trading opportunities. So here, if the price makes a deep correction mitigating the fair value gap area and grabbing the liquidity under these equal lows, we will have a perfect trading opportunity to go long. Now, when should we buy this pair? We know this move is a short-term downtrend in the lower time frames, so we will zoom into the lower time frame to look for reversal and trade entry. In the third step, we will wait for a change of character to confirm that the short-term downtrend is over and the market can continue pushing upward. We will use 2 entry setups to open positions. Number 1, if the change of character creates fair value gaps, we will place our buy limit a spread size above the order block. Number 2, if we have no gaps, we will use the retracement levels and enter positions in the middle of the 618 and 786 levels. Stops will be below the swing low and we can use multiple trade management strategies. Here's the checklist and important information about this trading plan we will use. You can risk 2 to 3% of your capital per trade and only have up to 3 open trades. But remember, before using this strategy with real money, you should backtest it on the past data to obtain the performance. Backtesting allows you to build the required confidence and prepare for potential risks associated with the trading. But unfortunately, it can be very time-consuming. Now, when we began backtesting, we randomly selected a period for the euro-dollar pair. Surprisingly, the first setups yielded a significant amount of profit. So let's walk through the chart step by step to illustrate what was going through our minds during the backtesting process. Here we have euro-dollar on the 4-hour time frame. The market has recently broken below the structure level, signaling a downtrend continuation. So we want to trade with the dominant downtrend. Here we have fair value gaps between the candles and this resistance level, which traditional traders will take as a short opportunity. So lots of liquidity have gathered above it. An optimal trading opportunity would be to wait for the price to mitigate the gap area, grab the liquidity, and look for reversal confirmations on the lower time frames to enter short positions. So we zoom into 15 minutes time frame and wait for the price to make a change of character to confirm the short entry. But as you can see, we have no change of character due to massive bullish pressure, so we won't have any short trades. So let's get back to the 4-hour chart. Here we can see that the price has broken above the recent lower high, indicating that the previous downtrend is no longer valid. Now, regarding market structure, we have a double bottom reversal pattern, with the second leg as a liquidity sweep movement. This strongly confirms that the market sentiment has changed to bullish. Now, we can identify a significant fair value gap on the chart, presenting a potential long trading opportunity. We will patiently wait for the price to return to this gap area, and then zoom into the 15-minute chart to enter long positions. On the 15-minute chart, we can see that the market has made a change of character, signaling that the short-term downtrend is over and the price can continue pushing upwards. This movement has created fair value gaps, so we'll use the first trading model. We'll place a buy order a bit above the order block and set a stop below the recent low. Now the market has given us another trading opportunity without triggering the first trade. There's a fair value gap and another order block, so we'll place another buy order without canceling the first one. We're still determining what the market will do next, but we will always stick to solid entry rules. In the best case, it will trigger one of the orders and continue pushing up, or it could reverse and cause us to lose both of the trades. Let's wait and see what happens. The price triggered our second trade and hit our target, resulting in a 4% gain. This is because we risked 2% of our capital per trade. Now, we have another order block and a new trading opportunity. So, without canceling the first trade, we'll open another position. Our first target will be twice our risk, and let's track our profits if the price moves in our favor. The close of these candles can be a reliable place to set our higher time frame target, and we will track our profits until we reach here. Let's see what the market does. The market has hit our first target, making us break even. This means that even if the price retraces and triggers our stop, we won't lose any money on the second trade. Every time the market makes a new higher low, we adjust our stop a couple of pips below it to secure our profits. Now this trade turned out to be great and gave us massive profits. But remember, trading live will be much more difficult because you also have to deal with emotions. However, backtesting on past data is the best way to test the trading system and prepare for different trading scenarios.